So let's work a few equity problems here. Here we have a missing piece. So we have enough data to solve for that question mark. So let's start there. So they tell us that common stock was issued at $42. And we know that what goes in that common stock line can only be shares issued times par. So that's 600,000 is $30 times the 20,000 shares. It cannot be anything else. So the $42 that was received as a capital contribution had to be split into two piles, the 30 and the part of the 42 that's above 30, called in excess of par. So that 42 above, 12 above par had to go into that paid in capital in excess of par common stock account. And how many shares were there? 20,000. So you had to put the $12 times 20,000, that $240,000, into that paid in capital in excess of par account. So now we know those three amounts as our starting point. Then they give us some new activity that impacts retained earnings. They tell us net income and the dividends. So beginning retained earnings was given, and net income makes retained earnings go up, and dividends make retained earnings go down. So then you can calculate the new retained earnings. And so common stock didn't change. There wasn't any more shares issued. We now know the paid in capital in excess of par. We know the revised retained earnings. And they did buy some treasury stock. They reacquired 4,000 at $48 a share. Treasury stock is negative equity. So that 4,000 times the 48 that they paid for it would reduce equity. So our new total equity would be the original common shares that didn't have a change, the 240 that we solved for. Retained earnings we updated for net income and the dividends declared, and then we reduced it for the treasury stock for the shares reacquired during the year on March 1st. All right, let's try. So here we get some beginning numbers, and we're trying to figure out what will total equity be after a stock dividend is declared and net income occurs. All right, so they tell us we have beginning retained earnings of 12,000 and total equity is 522,000. So the rest must be contributed capital, because equity is made up of contributed capital and retained earnings less treasury stock, if there is any. Right now there isn't any because they didn't tell us about it. So contributed capital is the 510. All right. So now, what about the stock dividend? What impact does it have on contributed capital and retained earnings? So when you declare stock dividend, you remove the dollar amount from retained earnings and put it into contributed capital. You put it into the common stock and the paid in capital in excess of par, splitting the two amounts. So what is the 10% stock dividend? So how many shares are outstanding? 20,000. 10% of that is 2,000. So we would remove 2,000 times the market value. Since it's a small dividend under 25%, it would be valued at market. And that would go up into contributed capital. It would go into the common stock at par and excess of par. Here they don't even give you that. They just want you to know theoretically it's going up in that portion of the equity accounts. Okay, and total equity didn't change. A stock dividend just rearranges furniture within the equity section. And then net income would make net retained earnings go up. All right, so after all that action, what does it look like? So contributed capital went up by the 34,000. Retained earnings went down by the dividend declared and up by net income. And so when you add those together, you get ending equity after the declared dividend and the net income is recorded. Let's try one more. So here we have equity before a stock dividend is declared. And then they tell us about the stock dividend. Okay, 10% stock dividend. So that's a small stock dividend below 25%. So it would be calculated at market price per share, which they give us $26. And they want to know immediately after the stock dividend, what does retained earnings look like? So retained earnings starts at $8.99. There's no net income, given that on one day you don't have net income. So their net income is not applicable here. So what would you remove here? You would remove the stock dividend. So that would be 10% of the shares outstanding. So they've got 100,000 shares outstanding. And it would be done at the market per share. So we would subtract 10,000 shares, that's 10%, times the 26. And so the ending retained earnings would be the $639. All right, let me know if you have any questions.